Gold is really kind of a policeman on the whole financial system. Gold doesn't change. We all know that. An ounce of gold, is an ounce of gold today, and 10 years from now, it'll be an ounce of gold. But maybe the 10 years from now, the price will be 30,000 per ounce or something in US dollar terms. Gold hasn't changed. What has changed? The value of the currency has changed.
I am bullish on gold and silver, don't get me wrong, guys, but I follow my discipline. And as Rick Roll likes to say, I'm now well beyond the point of no concern. And it's not because I knew that gold was going to stop at 4,400 or my secret sources in the CIA said they were going to attack silver at 54, above my pay grade.
Gold continues to act as the ultimate referee of the global financial system, unmoved, unchanged, yet quietly exposing the weakness of every currency printed against it. The metal itself doesn't rise. Instead, the value of paper money falls around it. As inflation accelerates and central banks remain trapped between a deflationary collapse and continued money creation, gold becomes the last line of defense against monetary deception. The system has reached a point where genuine deflation, driven by soaring interest rates or collapsing bond markets, would destroy confidence and liquidity. Instead, authorities are opting for the easier path, allowing the currency to fail and resetting it under a new digital monetary regime that is already being quietly tested abroad. David Morgan, a veteran precious metals analyst and founder of the Morgan Report, has long warned that this crack-up boom ends not with stability, but with a reset, one in which tangible assets reclaim their dominance. Alongside Lobo Tiggre, an expert in macro trends and resource investing, he notes that silver will not remain a mere industrial side story forever. As the fiat system weakens, its monetary nature will re-emerge, empowering millions who cannot afford gold to turn towards silver as their store of value and medium of exchange. When that moment arrives, gold preserves wealth, but silver multiplies it. Both metals, in their respective roles, will define the next era of financial reality. Now, we present the clips from their interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
Gold is really kind of a policeman on the whole financial system. Gold doesn't change. We all know that. An ounce of gold, is an ounce of gold today, and 10 years from now, it'll be an ounce of gold, but maybe the 10 years from now, the price will be, 30,000 per ounce or something in US dollar terms. Gold hasn't changed. What has changed? The value of the currency has changed. And the value of the currency is changing as we speak. The only thing that would mitigate a further increase in the price of gold is a huge deflationary event where the amount of currency is cut by a large number, like 50% or something. And that actually could happen if we had really a free market in interest rates, the price of money. So, for example, if what happened in 1980 under Volcker, where the interest rates were momentarily put above 20%, were to occur again, let's say go to 10% in today's environment, that would basically crash the bond market terribly. And if you had to mark to market and get your money out of your bond rather than getting that $1,000 face value that you're guaranteed at the bond expiry, and you had to cash it in early, that 10-year bond or 10-year note, you had to cash in at 5 years and you get half the money for it, that's highly deflationary. I don't think that's possible. The Fed knows it's not possible. The bankers know it's not possible because it would be such a disruption in the financial system. Basically, things would probably not function or not function very well. So what's the alternative? And that is to pretend everything's okay and keep inflating the money supply until the market itself takes over. And that's where you have, again, the crack up boom. So Fed's between a rock and a hard place, as the expression goes. The easiest method is to let the currency fail and reset. And of course, not behind closed doors. It's pretty open if you know where to look, and I'm sure you're aware of it, Vlad. But the new system is already being instituted. It's been in China for quite some time. That's sort of the beta test for the global currency or new monetary system. And it'll be a digital system. And how they wipe out the debt, I'm not sure. A lot of people have talked about how to wipe it out. It could be swap for Bitcoin, it could be a cryptocurrency, it could be a cyber attack, it could be an EMP, either natural or created. There's a lot of things that could mess with the way the system runs, which is basically on a bunch of computers, and those get wiped out or dislodged or hacked, and all of a sudden the reset button has been pushed, and now they wouldn't necessarily even have to revalue the currency, but they could and say, look, we're so sorry you lost your bank account, but to the best of our ability, here's what you had. Here's the new digital equivalent. Just give us a digital ID and you're on your way. Now, why is gold going up? I don't understand. It starts to catch on to the story and understand what we just discussed. To move that into silver is a little more difficult. The reason being is that most people understand gold is money, or they have some association with gold as money. But very few people, unless they're my age or older, really think of silver as even having a monetary aspect to it. And it hasn't in a lot of ways. I mean, I have many in my peer group that say, well, silver is just an industrial commodity. It's not money. You can't call it money. I differ with them, but my point is this. It is both an industrial commodity and money. But there is a point that will take place, in my studied view, where the monetary aspect of silver becomes the most important part of the silver story. And that's because the depreciation of the currency is so great that people will buy anything and everything that they can instead of holding on to their currency, as I said earlier, and they'll move into a hard asset. So people that have wealth will buy gold. People that don't have a lot of wealth will buy silver. And there's a lot of people, a lot more people that only have a few thousand or a few hundred to buy or purchase a hard currency with, or a hard metal with, than have the ability to buy, $100,000 worth of gold. So I think you will see more and more people buying silver for that monetary aspect. And that's when it moves away from its base case, where as an industrial commodity, it sells for the cost of production or slightly more. It leaves that part of the story behind. Not that part goes away. It's just all markets move at the margin. And when people want it for security, for safety, we think about what is the amount of demand for money. And the amount of demand for money is actually infinite. The reason it's infinite is people depend on money, or currency now, but money really, in order to survive. I mean, there aren't many communities outside of, Aborigines, even the Amish use some currency. So when you think you need it and you must have it, which we all more or less believe, but what you're holding is a false representation of something of value, and you start moving that 1 or 2%, or even 3 or 4%, it could get that high, into a market as small as the silver market, the price is indeterminable. I mean, it really is, because there's so little silver relative to the potential demand of infinity that people that wake up and say, oh my goodness, I'm going to buy 2 jars of peanut butter, but I got, my life saving is $12,000. I can buy, 3 gold coins, or I can buy this much silver. So I think the gold silver ratio will continue to come down, meaning silver's favor. We'll go from like 85 to 70. I'm looking at 70 as kind of a turning point, and then down to 60, perhaps 30, and maybe even to the historic classic monetary ratio of 15 or 16 to 1. And if that happens, the silver relative to gold will be like a 4-fold increase relative to gold. In other words, it'll perform much, much better. And I do believe that will happen, but I don't know it'll happen. So in that case, I think you should make sure you have both gold and silver. Gold for wealth preservation, silver for wealth preservation, but also that beta, that high volatility that may take silver far higher, because we could and will probably see silver used as a means of transaction before the new system reset, or perhaps even after, where people are willing to deal in silver coins or bars for goods and services, be it renting an apartment or maybe an automobile or perhaps even real estate. I don't rule that out. I think, in fact, you might see that more and more as the Great Reset starts coming toward us at a faster pace.
In a market defined by uncertainty and emotion, discipline remains the single most valuable strategy. The art of managing profits, not chasing them, often determines who keeps their wealth when the cycle turns. Using structured methods, such as a trailing upside maximizer, allows investors to capture the majority of a move while protecting against sudden reversals. When several winning positions begin triggering exit alerts simultaneously, it's not about one company. It's about the broader trend signaling change. The macro picture supports that caution. Inflation continues to rise while rate cuts persist, creating a dangerous mix of weakening growth and elevated prices. The classic ingredients of stagflation. Labor markets are softening, corporate layoffs are growing, and yet monetary easing continues. Taking profits isn't retreating, it's strategic defense. In volatile times, preservation becomes the path to future opportunity. Let's get back to the interview.
Buy low, sell high. Oil goes negative in 2020. That was a pretty obvious time to buy low. But when do you sell high? How do you know? I don't claim to be smart enough to time markets or know when things roll over at the top. So I have my own method. And you don't have to do what I do, but I do think everybody should have a strategy for how you're going to do this. And I call mine the upside maximizer. And I use something like a trailing stop, but it's not a stop loss. It's something that ratchets up as long as something keeps going up. And then when it rolls over, I get triggered, I get an alert, and then I take my profits. And that could be take a little bit, like just my initial investment, or it could be take a lot, like take it all, leave only the initial investment, or somewhere in between, right? That's a separate question. What the trigger just tells me, hey, something has changed for this stock, so do something about it. So I have these for all my big wins, and I've got a lot of big wins right now, right? So if one rolls over, there's something with that company. But if they all start rolling over, there's something with the market. So my answer is I don't have a method for timing market tops, but enough of these upside maximizers have rolled over, have been triggered, and I have executed, even though I'm optimistic. I am bullish on gold and silver, don't get me wrong, guys, but I follow my discipline. And as Rick Roll likes to say, I'm now well beyond the point of no concern. And it's not because I knew the gold was going to stop at 4,400 or my secret sources in the CIA said they were going to attack silver at 54, above my pay grade. It's just the math said, hey, this stock has rolled over. It's time to take some profits. I did. And now I have a huge whack of cash that, if the next big move in gold and silver is down, I'll be able to buy back in when the stocks go, they'll crater and I'll be able to buy cheap again. If not, I'll follow my plan and I'll buy more in copper, and happily so. I like to say, we have an expression in the woods, loaded for bear means you've got the big gun in case a bear shows up. In this market, I'm loaded for bull or bear. I've got a big gun of cash ready to go either way. If they're worried about the economy, focused on the labor market. And remember, people keep telling you, oh, we've got the historic lows in unemployment. Haven't seen employment this low for 50 years. That's comparing apples to oranges. The U3 unemployment rate that they're saying now is at historic lows is not the way it was 50 years ago. And, when they changed everything in the 80s, the number that's closer to that old number that we used to call the unemployment rate is what we currently call the U6, which gets, hush-hush, barely mentioned. And that's running like double or more the U3. So it's not true that the unemployment numbers are so low. And I think the powers that be, they know this, even if they won't admit it. Conspiracy theory on my part. I have my tinfoil hat around here somewhere. But those numbers are there. And any professional economist has to know the difference between these numbers and why they happen. So there are signs of weakness. Just this last week, it's more anecdotal, but we've seen major layoffs, not hundreds, but not even just a few thousand, but like tens of thousands, major layoffs. And interestingly, some of it blue collar, which speaks to the lower rung of the K-shaped economy, and some of it white collar, AI supposedly replacing all these people. That's a big deal. So if you've got that and you've got, another word they're not using is transitory, but they're basically saying it's transitory. Like, we're going to pay more attention to labor now, even though inflation is 50% above target and labor is near, record low unemployment, but we're more worried about labor right now than inflation. I really think they're speaking out of both sides of their mouth when they say things like that. But anyway, transitory or not, right now inflation is going up. PCE, CPI, core this, that, or that, or any number you want, for almost half a year now, these numbers have been going up. So the Fed is cutting while inflation is rising, and it's never got down to its target. And there's signs of weakness in the labor market and in the broader economy, K-shaped or not. So to me, that looks like stagflation. Implications, history doesn't always repeat, but if it rhymes at all, and this is a funny thing to say with gold still holding over $4,000 an ounce as we talk, and silver still, below 50, but near that very a nice historic number, right? So with our monetary metals at these levels, to say that the outlook is stagflationary, which last time we had a serious bout of stagflation sent gold and silver screaming higher, if I was a cheerleader promoter type, but that would be all I would talk about. So there is a scenario here, though, where we go much higher. And I don't deny that, despite my Darth Vader reputation. But there's also a scenario that the market has sniffed this out in advance. And the current highs are actually that scenario priced in advance, and the next big move is down. So I'm sorry, there we go. I'm raining London Parade, folks. I couldn't talk about the rosy scenario without balancing it with the not so rosy scenario, which, if I may, brings me to the bottom line of my presentation today, which was not sell, get out. It's not Lobo turn bearish, put away the rotten tomatoes, but it was my mantra for right now. Nobody goes broke taking profits, and taking profits does not mean selling everything and running for the hills. But at the very least, it means locking in, getting your money back off the table so that you can't lose. Or in my case, I've actually been locking in gains so that whatever happens last, not only can I not lose, I cannot not have a big win because I've locked that in. And things have gone up so much that I can do that and still have more money on the table than I started with. So I'm still, if the next big move is up, I have more money on the table than I started with. I benefit. If the next big move is down, I haven't just gotten my money back. I've gotten more than my money back. So I still have a big win, even if it goes down. So it's win-win either way. Well, it's sort of win-win more, depending on how things go. It's interesting how, the tariffs and the upset, objectively, we have to look at it and look at the markets, look at the economy and say, it really hasn't been that bad. We if we were in the bear camp and we thought Trump shock was really going to upset the apple cart, we should have seen a much higher spike in unemployment by now. We should have seen more of the tariff costs passed on to consumers. And a lot of people saying, well, but they can't hold off forever. And there's talk of the K-shaped economy. Yeah, but the people on the lower part of the K, they're really suffering. And all of that may be true. But the fact is that the economy hasn't really tanked. And maybe one way of looking at this is Lynn Alden's "Nothing Stops This Train" riff, right? Or my simple, humble wolf way of looking at it, the money helicopters are still in the air. So yeah, there's all this negative stuff is happening, and yet we have another record earnings season. And it's not just the AI build, right? There is more breadth in the market now. It's the Dow is doing okay, not just the S&P 500 or the Magnificent Seven. So there are actual signs that the real economy it's held up better than I thought. And so here it may just be a matter of time. If in the next month or two, nothing blows up, I'd probably be, I don't know where the bottom is, but I'm confident enough in the thesis. I'm just going to start buying anyway. And if it fluctuates, I'll average down.
The lesson here is simple. Discipline outlasts emotion. Markets will rise, fall, and tempt even the most patient investors to act impulsively. But consistency and risk control remain the true edge. When the data shifts, adapt. When profits are on the table, protect them. No one ever went broke taking gains, yet many have lost everything by refusing to do so. The ability to step back, reassess, and prepare for either outcome, bull or bear, is what separates speculation from mastery. This cycle isn't about chasing the following headline or calling the exact top. It's about staying solvent, strategic, and ready for the next great move when the dust settles. Those who protect capital now will have the power to deploy it later, when opportunities are abundant and fear runs high. Share your thoughts on their analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.